Welcome to this Business Tax Roundup for this month. My name is Dean Wootten. Let's consider Martin and Denise Arthur. Now, Martin Arthur advised taxpayers on appeals to the tax tribunals. He was an ex-HMRC person, and after leaving HMRC, he wrote a book called Taxpayer Strikes Back, and it was just full of tips as to how to deal with HMRC. Now, his business operated through two companies that he controlled and partly owned. His wife was a shareholder in both companies and had previously been a director. Now, the companies ran into difficulties and were eventually closed down. Unfortunately, he was convicted of cheating the public revenue from 2008 through to 2013. And he had to pay £120,000 worth of tax and interest. There was about 80-odd thousand tax and 30-odd thousand interest. He had submitted inaccurate tax returns and deliberately kept incomplete records to hide this. Now, the appeal was concerned with establishing what, if any, undeclared tax liabilities arose in respect of the tax years up to 15-16. Now, HMRC argued that there was undeclared personal income received from these companies, and they issued a number of assessments and penalties for deliberate inaccuracies. They were looking at the couple's bank statements compared to the company bank statements, and they created a list of anomalies, and these anomalies they thought was untaxed money received by the couple. Now, HMRC regarded that money as taxable profits from self-employment, and that was quite an unusual stance, but I think this case was quite unusual. Now, the couple argued that the net balance owing to the companies should be taxed under Section 455, i.e. as a director's loan, effectively. Now, the first tier were not too sympathetic with Mr. Arthur. Now, they found that Mr. Arthur treated the company's money as the couple's assets, and he didn't accurately record amounts paid and received, and he didn't think there was any requirement to repay the net sums that he actually received either. As far as they were concerned, the company's records were not accurate, so therefore for them, the only sensible course of action was to treat the income as taxable self-employment income and not a loan from the company. His mental health issues and alcohol dependency did not make his actions careless. They were deliberate, and his penalties were therefore upheld. Now, by 15-16, his wife was aware of HMRC's criminal investigation into her husband's affairs, but she continued to allow him to submit her own returns without checking them. So therefore, any deliberate penalties on her for 15-16 did stand. However, before 15-16, she was not aware of her husband's criminal investigation, so the earlier year penalties were recalculated as careless. Now, this case is just an example of somebody deliberately not keeping records, deliberately submitting inaccurate numbers, and he was offered a disclosure facility, but he rejected that, so therefore they went for the criminal route, and unfortunately he did suffer through that route. But if clients do get found out for inaccurate returns, deliberately making inaccurate returns, then I would say if they're offered a disclosure facility, then they should take it. This chap didn't, for whatever reason, didn't take it, and he ended up in quite a lot of bother because of that. Let's consider an interesting case on disguised remuneration within an LLP. This case is Bluecrest Capital Management, and this LLP managed investment funds and provides support services to other group entities. Now, some members ran the investment portfolios with capital allocated to invest at their discretion. Now, the members' remuneration, the members that were under consideration, included variable bonuses determined by reference to their performance as well as the performance of the business as a whole. Now, let's look at these salaried member rules. So they brought in some rules a few years back, HMRC, where they were under the impression that within LLPs there was an awful lot of members that weren't actually self-employed. They were, in reality, just senior employees. But because they were described as members, they were treated as self-employed, and they avoided essentially employees' national insurance and employers' national insurance. So these rules came in a while back. Now, if conditions are breached, members, LLP members, are deemed to be employees and therefore liable to POA and national insurance, rather than being self-employed members of the partnership. Now, for the rules to apply, an individual must meet 3 conditions. Obviously, you don't want those 3 conditions met. So if you breach one or more of the conditions, then the POA rules will not apply. Now, it's common ground in this appeal that condition C applied, and that is no significant capital introduced. So all parties accepted that there was no significant capital introduced, so therefore condition C was met. The debate came about conditions A and B. Now, condition A applies where at least 80% of the income for that particular member is regarded as a disguised salary. A disguised salary is effectively fixed income or variable, but without reference to overall profits. And the question here for condition A was there bonuses, or were there bonuses variable without reference to the profits of the LLP as a whole? And the other condition is B. Did the members not have significant influence over the LLP's affairs? Because if they did, then condition B would be breached, and a breach is good because a breach means self-employed treatment sticks. Now, HMRC believed that these conditions were met. They believed that at least 80% of the income was from disguised salary. They believed that the members did not have significant influence over the LLP's affairs. And as A and B were met, and condition C was met, then the POA rules applied. That was HMRC's stance. And their determinations covered 5 years. Alright, so the first tier, they looked at condition A first. Now, condition A is where at least 80% of the amount paid to a member is treated as disguised salary. If it is, then condition A is met. Now, disguised salary is not only fixed amounts, it includes amounts that vary without reference to the overall profitability of the LLP, or are not in practice affected by the overall amount of those profits. So it might be that your particular profit bonus effectively is how your team performs. That unfortunately would not be regarded as just normal profits. It would be regarded as disguised salary. Now, the first tier tribunal thought there was not a satisfactory link between the LLP's profits and their variable remuneration. It was not good enough to say that if there were fewer profits available for distribution, then the individual member is going to receive a lesser amount. So in the first tier's opinion, condition A was met. At least 80% of the amount paid to a member was disguised salary. So all hinged on condition B. So did those members have significant influence over the affairs of the LLP? If they did, then condition B is breached. Breach is good. POA would not apply. So it's all about this significant influence. Now, this influence did not have to be over the LLP's affairs as a whole, in the first tier's opinion. It could be over one or more areas of the LLP activities, including financial influence. Now, in the first tier tribunal's opinion, significant influence did exist for members who were LLP heads of departments and members who managed portfolios of at least $100 million. Now, for those members, the POA rules did not apply as there was significant influence. Now, other members were salaried members as conditions A, B and C were met. So they didn't have that significant influence. So therefore condition B was met, condition A was already met, condition C was already met. So some members were salaried members. So the appeal was allowed in part. Some members breached condition B, some members didn't. So therefore POA treatment for some and not for others. So partial victory. Well, let's look at an SDLT case, but I think it has other implications as well. And this is looking at valuations on incorporations, and this was looking at transferable goodwill. Now, Dr. Denning, she ran 2 nursing homes as a sole trader. In 2010, she incorporated her business into a parent co, 2 subsidiary structure. So one parent co with 2 subs, one care home went into one sub, the other went into the other sub. Now, the transfers included the grant of 2 5-year leases with no premium. And as there's no premium, there's no SDLT. Now, the transfer also included the sale of goodwill for 1.8 million, and there's no SDLT on goodwill. HMRC believed that the goodwill was inseparable from the leases, and the SDLT was due on the 1.8 million property transfer. Now, taxpayers said the business was worth 1.8 million, and as the leases were at market value, the rent was at market value, the 1.8 million must relate to goodwill. And the upper tribunal actually agreed with the taxpayer. Unfortunately, the Court of Session believes there is only one leasehold asset to value, and as such, SDLT is due on the 1.8 million consideration. So they don't believe that goodwill is separable from the business itself, or from the property itself, I should say. So therefore, when you're transferring, in this case, the leases and the business, they are inseparable. The 1.8 million relates to the property, which includes the goodwill, and therefore SDLT is due on the whole lot. It does look a little odd, this case. So, for example, are the rents really at market value? Because if they are at market value, then why would I be paying 1.8 million type thing? So it kind of, I'm not convinced about the valuations of the actual rents. I think the rents were probably a little low. So therefore, you should have paid a little bit more for it. But it's going into areas where probably the RICS chartered surveyors are obviously better placed than I am to value it. But it does seem a little odd to say the rents are at market value, and that's only a 5-year lease, but we want you to pay 1.8 million for it. So I think probably that the assets are not separable from goodwill. So therefore there is one transfer of the business. The business is effectively a care home, and then SDLT is due on the 1.8 million. So the Court of Session overrides the upper tribunal. SDLT is due on the larger amount. And it obviously does cause issues when we are transferring businesses which are very much property businesses, so like rest homes or restaurants with a great location. Do you then separate goodwill from the property and only pay SDLT on what you perceive to be the property amount? It doesn't look like it. It looks like the Court of Session here is supporting the fact that where you've got a business which is heavily linked to property, like hotels, rest homes, etc., then separating out goodwill does seem to be something that the Court of Session doesn't think should happen. And obviously this decision will affect HMRC's approach to other similar situations. Let's now look at a repayment of participator loan case, section 455, using a group company. So effectively a loan account was repaid using another loan from another group company, and that avoided 455 tax, or that was the plan anyway. Now, M was the majority shareholder of Z. Z had a 31st of May year end. Z was the parent company of a very sizable group. Now, M's director's loan account was just under 10 million as at the 31st of May 16, and this compared with 188,000 credit balance at the start of the year, so quite a busy year for Mr. M. Now, if the loan was still outstanding at the 20th of February 2017, 9 months and 1 day after the year end, the company would have a significant Section 455 liability. Now, further loans were made to M by group company Y at commercial rates. And the advisors thought, well, he could have borrowed from a third party at commercial rates. So the advisors didn't think there's anything wrong with that. Now, M used those loans to replace director's loan account with Z before the end of February 17. And by repaying those loans, the 455 charge was avoided. Now, HMRC viewed the arrangement as one that created a tax advantage, and the matter was referred to the GAR advisory panel, so the General Anti-Avoidance Rule. Now, panel looked at this, and they appreciated that arrangements to repay Section 455, or repay loans which avoided Section 455, were matters that they should look at, for sure, but they didn't feel that this one was an artificial transaction. he was borrowing at commercial rates. He could have borrowed from a third party at commercial rates, and he was using that commercial loan, effectively, to repay his director's loan account. The fact that they came from a group company to the GAR advisory panel did not appear to them to be artificial. So that, I think, gives us quite a lot of encouragement in similar situations. But I would think you've got to document the loan and make it a proper loan with proper terms, commercial rates, etc. And then it's not an artificial transaction. Let's look at VAT now. Now, first case we're going to look at is Netbusters. Netbusters organised five-a-side football and netball league matches. And they managed all aspects of the league administration. They hired pitches from third parties for the teams to play their league matches on, etc. Now, the company were paying output VAT, but then they reclaimed output VAT on the basis that its suppliers were 87.5% exempt, being the supply of a sporting facility, Schedule 9, Group 1, and 12.5% taxable as a supply of league administration services. Now, HMRC refused the claim, arguing the company made standard rate suppliers of the competitive league sports management services, so wholly standard rated. Now, the first tier found the services were a single composite exempt supply of the right to occupy land. So even better, I guess, than what Netbusters were arguing. And HMRC appealed. Now, in the upper tribunal, HMRC argued the first tier had erred in law. They had not applied the passivity principle that you need for land. They had not considered the objective character or economic reality of the company's supplies. Yeah, they were, in their mind, the runners of a football and netball activity. Now, the upper tribunal found that the first tier tribunal had applied the correct tests. They had considered all the relevant case law. They had correctly identified two supplies, the exempt pitch hire and the taxable lead administration, and acknowledged that both enhanced the other. But they concluded that the character of the supply was predominantly the hire of the land. The administrative services were viewed as ancillary to the main supply, to the main exempt supply, and as such, the first tier had not erred in law, and they had reached a reasonable conclusion. Their income was exempt, and the output tax was repayable. And presumably this will then open not the floodgates, but if you've got similar clients that are doing, running leagues, etc., hiring pitches, then we should look at this and say, well, if we're on all fours with this case, can we not go back 4 years and claim back the output tax? Now, obviously, if you are claiming back the output tax, then you've got to look at the knock-on impact of input tax. So it's not a straightforward, full-blown output tax repayment. If you've got more exempt income than you previously thought, then that will have a knock-on impact for input tax. So it is almost like a spreadsheet being needed to rework what you should have effectively had. We'll now look at North Church Homes Limited, and this was concerning whether a building was a new construction or possibly an extension. Now, Schedule 8 Group 5, Note 18b, building work on the construction of a new house can be zero rated, so new construction of houses is definitely zero rated, but if there's a previous property, then that property must be completely flattened, demolished, to get the new build treatment. If you leave something above ground, then it hasn't been demolished, and what you've then got being built is not a new home. It might look like a new home, but if you've left something above ground, you don't get the new build treatment. Effectively, it's an extension. In most cases, a standard rated extension. Now, you are allowed to leave a single facade if the planning permission requires that a single facade must be left. So if I demolish the building that was there, but leave the single facade, because that's what planning needs, then what comes next is a new build house, and that will be zero rated. Now, HMRC rejected the company's claim for zero rated construction costs as more than a single facade was retained. There was part of the roof being retained, there was a ground floor bay being retained, there was other bits and pieces being retained. It's really strict, this condition. You have to flatten it, you literally flatten the thing, If planning says single facade is okay to be left, then that is all you must leave. If you leave more than that, then you haven't got a zero-rated new construction of a property. It's effectively an extension or an alteration. Now, when the company appealed, they said, well, if we lose the zero rating argument, which I think they kind of expected to lose, because they should lose it, because the property had been lived in during a period of 2 years prior to the work starting, then the 5% work rate would have applied, and that should. I mean, if it's been empty for 2 years when the work starts, then the work should be at 5%. So that was the basis, or the second string, if you like, of their appeal. Now, the first tier, no surprise, they concluded that, look, you've left more than a single facade. Zero rating does not apply, and that's fair dues. It doesn't apply. If you've left more than a planning permission required single facade, then it's not a new build. So that's fair enough. They also went on to conclude that as the house has been empty for more than 2 years before the work started, then the contract should have been at the reduced rate of 5%. So if 5% was the VAT rate they should have incurred rather than the zero rate, they're not going to recover the 5% because whether they're going to be selling the property afterwards or letting the property afterwards, the sale or letting of that property will be exempt. So therefore, the rate is 5, but they will bear 5. But obviously, it's better than bearing 20. When I look at a charitable case, now the charity's primary objective here was to achieve 0 road traffic fatalities. Now, the charity, as part of their objectives, they bought new cars and undertook crash testing as almost like a mystery shopper. So they bought the cars and they did crash testing and they gave reports. And they published unsatisfactory results. And this was changing customers' buying behaviour. I mean, customers were not keen to buy a car that had very bad crash ratings. Now, as a result of their reports, the manufacturers were prompted to improve safety features. And as they improved them, they proactively sought and paid for further testing by the charity to gain improved ratings in the market. Now, the issue here was, the paid for follow-up testing by the manufacturers was a business activity and input tax recovery was allowed. There's no problems with that. Now, HMRC argued the initial free testing funded by the charity was a non-business activity and therefore no input tax could be reclaimed in respect of the non-business activity. And HMRC raised assessments restricting the overhead input tax recovery rate by 40%. Now, charity argued that the free testing was not a separate activity in its own right. It was just part of the initial work that led to the subsequent charged testing work. I think that's a fair argument. Now, the first tier concluded that the free testing was an inherent and integral part of the business activity, i.e. the paid-for testing. It was not part of the organisation's charitable aims as laid out in the Articles of Association. So the appeal was allowed. And I think quite a sensible decision, quite an important decision for charities. Again, doing something initially for nothing and then later on getting paid something for something which comes out of that is normally going to be regarded as part of the whole business activity. So no restriction there on input tax recovery, provided, of course, the business activity is taxable. Well, that concludes the Business Tax Roundup for this month. My name's Dean Wootten. Thank you for listening.